I am Mrs. S. Abubaker and welcome to Part 2 presentation on the IFRS 3 amendment that is effective from 1 January 2020. In Part 1, we introduced the concentration test and general overview of how it works. We will go into further detail in this part whilst using IFRS as a tool. So paragraph B7b says that the concentration test is met when substantially all of the fair value of gross assets acquired are concentrated in a single or group of similar identifiable assets. So how does the concentration test work? The standard is clear on what is excluded and included from the concentration test outlined in paragraph B7b, A and B of IFRS 3. Use your IFRS textbook, highlight this paragraph, and know where it is for quick access in an exam or test. So the fair value of gross assets acquired for purposes of the concentration test excludes cash, deferred tax assets, and deferred tax liabilities, and not forgetting the deferred tax liabilities resulting from any IFRS 3 fair value remeasurements at acquisition date. The reason for excluding the relevant items and related tax base is because they are independent of considering whether the underlying process involved constitutes a business as defined. Items specifically included in the concentration test is the consideration paid, NCI at fair value, and if any previously held interest at fair value on acquisition date. The total in excess of or removing the net asset value acquired. This paragraph at first read may be confusing and brings to mind the question, what are we comparing to what to determine substantially all? In other words, substantially all of what? Let's look at an example for more clarity. Please refer to illustrative example under IE 118 example I in your IFRS Part B textbook. This simple example just puts numbers to the text. So in this example, an entity purchases 20% shares in another entity with no control obtained. Later, the entity then purchases another 50% in this other entity, and so leaving it with 70% control. The fair values of the assets and liabilities as well as the deferred tax liability is given. Note, be careful if there is cost prices and carrying amounts given. Look for the fair values. The numeric fair value of all of the gross assets that are evidently different in risk and nature. For instance, a building and an intangible asset. These assets are not similar in risk and therefore do not represent a single identifiable asset, but it would not constitute a business if the fair value of these gross assets combined is substantially all of the identifiable assets. Let's apply the principle to this example. We structure the calculation just as the paragraph instructs, and include the fair value of gross assets acquired besides cash and deferred tax assets. So if we compare the gross assets acquired to the total calculated specifically for the concentration test, we would get substantially all. Furthermore, the excess amount is an indication of how much of what is paid is actually attributable to a process in place and not just the assets. Therefore, the higher this amount, the more likely that the concentration test is not met. As mentioned, the deferred tax liability is not taken into account as it does not contribute to the business process itself. Therefore, in this example, the gross assets acquired at fair value is 100% of the value calculated for purposes of the concentration test. Therefore, the concentration test is met and this acquisition is not a business. Now let's change the consideration paid and see the difference in conclusion. The consideration paid now is, let's say, 2,000 Rand. All other information stays the same. Is the concentration test met? After updating the relevant totals, you can see that the excess amount is much larger, which indicates that more value is placed on the process in place. So when comparing the fair value gross assets acquired of 1,000 to the 2,800, the assets only make up 36% of the total for the concentration test. Therefore, we would conclude that the concentration test is not met and that further assessment is needed to determine if the acquisition is a business or not. One issue that the standard does not specify is what percentage threshold is used for substantially all. This is subjective and assessed on a case-by-case basis. An alternative calculation is also indicated in the paragraph B7b, where it states that the fair value of gross assets is calculated by adding these three items as well as adding the liabilities and excluding paragraph A items. For this example, it is only cash and cash equivalents. You should then come to the same answer of 1,000 for purposes of the concentration test. Lastly, as paragraph B7b requires to assess if the assets acquired are a group of similar identifiable assets, in assessing if the assets are similar or fall into the same class of assets, the guidance for these is stipulated in IAS 38 intangible assets, IAS 16 property, plant and equipment, and IFRS 7 financial instruments disclosures should be used where relevant. We will touch on this aspect in the next video, so keep watching.